professional responsibility and liability. As auditors, you are responsible for some things that you are doing, and then you also face the liabilities, because those who will be using your financial statement may send you to court. The directors can send you to court. The shareholders can send you to court. Therefore, it may be a liability. It may end in as a liability. So, professional responsibility and liability. That is the topic. Now, auditors' liability and the expectation gaps. Expectation what? Gaps. What is an expectation gap? What the auditors know that they do, they were taught to do, vis-a-vis what the public think that they are supposed to do. So that is what we call expectation gap. Now let's see audit expectation gap. The expectation gap is the difference between what the users of financial statements and other members of the public think the auditors should do. So the public think that we, the auditors, should do A, B, C, D. But we were also taught that we have to do X, Y, Z. So you could see that there is a difference. That is the gap. So I go over again. What the expectation gap is the difference between what the users of financial statement and other members of the public think that the auditors should do, and what the auditors are actually required by the law and the profession to do. So our profession taught us what to do. The law also said we should do A, B, C, D. But the public think otherwise. That is what we term what? The difference between the two is what we call what? Expectation gap. There are three main elements in the expectation gap. The expectation gap, there are three elements in it. One, the standard gap. The standards gap. This occurs because of a perception that auditing standards are more prescriptive than they actually are, and that auditors have wide-ranging rules that they must follow. What they mean is that they are thinking that the standards that we use, they are prescriptive. Instead of being what? A way of auditors coming out. Now, let's go to as follows. One, performance gap. This occurs because of a perception that audit work has fallen below the required standards. Yes, performance. This occurs because of a perception that audit work has fallen below the required standards. That's what the perception is. Another one is what? A liability gap. This arises from a lack of understanding about the auditor's liability and who the auditor may be liable to. That is another gap. The second one again, this arises from a lack of what? Understanding about what? The auditor's liability. Who the auditor may be liable to. Is it the general public? Is it your clients or the shareholders or the directors or who and who? So that is a liability gap. Consequence of the expectation gap. What are the consequences? The results of expectation gap. The results are that higher rates of litigation. Higher rate of what? Litigation due to the perceived negligence of auditors. So once the expectation gap is there, people will be forced to what? Take auditors to what? Courts. So higher rates of litigation will happen. Then incorrect decision by users of audit reports who base such decision on incorrect premises because they don't understand why auditors will say true and fair. So they will use those opinions to make decisions. And those decisions may be on incorrect premises. The last one is an increase in mutual distrust between the auditing profession and users of audit reports. Yes, there is mutual distrust between the auditing profession and users. Those who are using the audit reports are saying different things, while the auditors know that these are what you are supposed to say. Closing the expectation gap. Yes, how do you close it? Now there is a gap between the two groups. There is a gap. The public says this is what auditors are saying. Then we, the auditors, say that the law and our standards say we should say this. So there's a gap different between the two. The profession should attempt to improve the general level of knowledge and understanding about the audit process. So there should be what? Education. There should be proper education on what the audit processes are and what the audit report means. So the profession should attempt to improve the general level of knowledge and understanding about the audit processes. Significant guidance for auditors and management aimed at increasing quality and addressing issues such as going concern. Yes, there should be proper guidance for auditors and management aimed at increasing quality and addressing issues such as going concern. If those things are done, at least we are closing the gap. The next one is financial reporting participants should work together even more effectively to improve the deterrence and detection of financial reporting fraud. So we need to work in what? Partnership. So that fraud and other things can easily be detected. Then the last one is open and candid communication between internal and external auditors. Financial management and audit committee. There should be what? Open and candid communication between internal and external auditors. Financial management and the audit committee. Fraud and error. What is fraud? Fraud and error. ISA 240. What is fraud and error? Fraud and error, as we said, fraud may be defined as intentional acts. Fraud may be defined as intentional acts which may involve fraudulent financial reporting. Fraudulent financial reporting. That's falsification of records or documents, a deliberately incorrect application of accounting policies. So when they say fraudulent financial reporting, it includes what? Falsification of records or documents, a deliberately incorrect application of accounting policies. So that is fraudulent financial reporting. Then we have misappropriation of assets. Misappropriation means taking let's say the company's what? Assets, whether it can be cash, it can be any of the stock, it can be anything, and misapply it. That is misappropriation. Take it for yourself, which is not, it is not yours, but you take it for yourself. You have misappropriated it. Error may be defined as what? Unintentional misapplication of accounting policies. It is not intentional, but fraud is intentional with the aim of concealing it. But error is unintentional misapplication of accounting policies. Oversights, unintentional clerical mistakes, or unintentional misinterpretation of facts. So the one who is committing error doesn't know that he's committing it. It's unintentional. But the one who is committing fraud knows that he's committing fraud. So he will make sure he conceals it. The key distinction between fraud and error is therefore whether the effect on the financial statement is what? Deliberate, which is a fraud, or unintentional, which is what? An error. Responsibility of management and auditors for fraud and error. Who is responsible for what? Fraud. That's what they are saying. Responsibility of management and auditors for fraud and error. So what is management's responsibility? Management is therefore responsible for the prevention and detection of what? Fraud and error. It is management responsibility to detect fraud and to prevent fraud. The auditor's responsibility is to obtain reasonable assurance. Yours is to what? As an auditor, you are to what? Obtain reasonable assurance that the financial statements taken as a whole are free from material misstatements. whether caused by fraud or error. So yours is to what? Make sure you obtain reasonable assurance. Reasonable assurance means you are going to do more work to be sure of yourself that the financial statements taken as a whole are free from material misstatement, whether caused by fraud or error. So in a scenario question, they may give you a scenario question where they will ask you there was a fraud in the system, and because that fraud has not been detected by the auditor, management say they will not pay him because the fraud has come out, and their perception is that the auditor is supposed to what? Prevent fraud and detect fraud. Here we have been taught that it is not auditor's responsibility. It is rather management responsibility. So if a scenario question comes and they ask you what action can the auditor take, it's not the auditor's responsibility. So please learn around that area. Let's go. It is not the primary responsibility of the auditor to prevent or detect fraud or error. Although the audit may act as what? Deterrent to fraud. Yes. For the mere fact that they say auditors are coming, if somebody is perpetrating fraud, the fellow will sit up. So it is just a deterrent to fraud. As are 240 responsibilities, management and the auditor. So they have not shared it. Let's see. The primary responsibility for the prevention and detection of fraud rests with both those charged with what? Governance of the entity and management. Those charged with what? Governance are the board of directors. Those board of directors, they are charged with the governance, whilst the management manages the what? The company. An auditor conducting an audit in accordance with ISS is responsible for obtaining reasonable. So yours as an auditor is to obtain reasonable what? Assurance that the financial statements as a whole are free from material misstatement, whether caused by fraud or error. So that is it. The responsibility of detecting and preventing fraud lies squarely before what? Management. Whilst that of what? Auditor is to what? Be able to what? He's responsible for obtaining reasonable assurance that the financial statement as a whole are free from material misstatement, whether caused by fraud or what? Error. Now, every fraud that is perpetrated, there are risk factors. So fraud risk factors. Fraud what? Risk factors. What you mean by that is that what makes people to defraud? What makes people to be fraudsters? That's what they're saying. So fraud risk factors are defined as events or conditions that indicate an incentive or pressure to commit fraud or provide an opportunity to commit fraud. So for somebody to defraud or to be a fraudster, it means either he's getting incentive from it, or there is a pressure on him to do some things or to commit it, or somebody has given the opportunity for him to commit it. So fraud risk factors are classified based on three conditions. One, incentive or pressure. Let me explain the incentive here. Assuming that your colleague went and stole or defrauded a company, he was not caught. Then he built mansion, buy so many cars. You see, it is enticing. So you think that it's an incentive. If you're able to do it, then you are okay. It's an incentive. What about pressure? Let's assume that you have a child who is in the university and he has been sacked for school fees. Meanwhile, you are the cashier who is always counting money. There is a pressure on you to probably misappropriate the cash and promise that you pay it later. That's you promise secretly to God that you pay it when the moon dies. I'm telling you, you may not be able to pay it. And it will accumulate and accumulate and accumulate. That is the pressure. Just an example of the pressure. Rationalization. Before anybody, human being, does anything, he rationalizes, or his attitude will show. So he think about the effects of that action. That is what we call rationalization or attitudes. If you are Christian and you are going to defraud, then you think, if I'm able to do this, I can get this or this. Now you can also think another way that I'm a deacon. If I'm caught, so you are rationalizing which one is more important, greater. Then you go and do it. That is the rationalization or attitudes. Then the last one is opportunity. If the opportunity doesn't come, you cannot do it. There's no way. That is where all managements are advised to put internal controls in place so that as a measure to prevent what? Those acts. So that is it. Let's go to the next one. Procedure for suspected fraud or error. Assuming you suspect fraud to be happening in your client's organization, what are the things that you do, the steps you take? 1, identify the extent and possible impact on the financial statement of the fraud or error. So identify the extent of possible impact on the financial statements. That's the first thing. Number 2, because consider the possible impact on other areas of the audit and on the overall assessment of audit risk. The reason is that fraud you are suspecting may affect your opinion, may finally affect your opinion. Then the third one is the findings should be discussed with management. Whatever findings you come to, that means you suspect fraud. Those findings should be discussed with management. The next one is the auditors should determine the action that management should take. Yes. Which action do you expect the management to take? If you advise them to do A, B, C, D, so that is what you expect them to do. All right. The auditor should normally communicate on a formal basis to management at an appropriate level. So it means when you detect you suspect fraud, you need to communicate with management. And they are saying that you do that by writing management letter to management. The auditor should consider the impact on his audit report to the shareholders. So as an auditor, that particular fraud or suspected fraud or error, is it having impact on your report? If it has impact on your report, how do you report it to your shareholders? Then the next one is the auditor should consider whether there is any requirement to report to appropriate authorities. The appropriate authorities, there are so many regulators, so many appropriate authorities. The bank, if you are auditing banking institution, if you have suspected fraud or error, you can decide to report to Bank of Ghana. If it's insurance company you are auditing, to what? National Insurance Commission, and so forth. Professional skepticism and fraud. Skepticism. The audit team should discuss the possibility of fraud in the context of the specific characteristics of the audit engagements. When they say professional skepticism, it means that being alert to fraud or suspected fraud, be alert to circumstances. So if you are supposed to, let's say, as far as fraud is concerned, they are saying the audit team should discuss the possibility of fraud in the context of the specific characteristics of the audit engagements. So the next one is discussion should be held with management on the procedures in place to detect or prevent fraud. Yes. You need to discuss with management. As to procedures they should put in place to detect or prevent fraud. Then the risk of possible fraud should be identified and its possible impact on the financial statement should be evaluated. The risk of that fraud should be assessed. The impact should be assessed on the financial statements. And then audit procedures should be designed to obtain evidence that the fraud, which may impair the financial statement, has not been detected and corrected. So it means you put more procedures in place so that those suspected fraud which may impair the financial statement has not occurred. Auditors' liability. Now, I told you from the beginning that auditors are expected to do some things. And since they are expected to do some things, there will be what? Liability in case they didn't what? Perform the audit to satisfaction. So, auditors' liability. Legal claims. Yes. Legal claims. Yes. Legal claims made against auditors fall within one of the two legal strands. So there are two ways you can be what? Legal action can be taken against you. The auditor may be prosecuted by the authorities for what? A criminal act. If it is a theft or something which is criminal, you can be prosecuted for that and be criminally liable if found guilty. So if you are found guilty, as far as that criminal prosecution is concerned, then you may be found guilty. Then you have to either go to prison or you go to prison and pay something in addition. Then we also have auditor may be liable under civil law. The civil law, in actual fact, means that an individual user of the financial statements which you have audited may take civil action against you. So a civil legal action may be brought against an auditor by another person who has suffered loss or damage because of the auditor's action. Legal systems relating to Ghanaian what? Auditors with its two main strands. Criminal law and then what? Civil law. So they have given the criminal law, that is fraudulent trading or insider dealing. Then civil law, contract law, and the law of torts. And laws being established by what? Statute, that is the Companies Act, etc. Common law, procedures set by rulings in previous legal cases. That is the common law. Criminal liability, yes. Now let's come to the criminal liability now. Examples of when the auditor may be criminally liable include what? Where he accepts appointment as auditor under a statutory provision without being qualified to act. So initially, when at the beginning of the class, we discussed who qualified to be an auditor. And they say you must be somebody who is qualified with ICA Ghana. And you must be a member and you must be given the license to practice. So if you can be charged if you are not qualified to act, but you act, that means you are going contrary to what the law says. 2, where he is involved in fraud, such as falsifying accounting document or record. If you are found as an auditor, falsifying accounting documents or records, it's a fraud. Therefore, you may be criminally what? Liable for it. Where he is guilty of insider dealing. You all know what is insider dealing. That's you take part in let's say, an important meeting, then you take advantage of that particular institution and then to benefit you. That is insider dealing. Criminal liability may also arise for certain offenses relating to what? The winding up of a company, tax law, financial services legislation in areas such as dealing in investment and giving investment advice, money laundering. All these areas, criminal can be. Let's come to civil liability. A major threat faced by the auditing profession is the possibility of legal claims against auditors as a result of what? Negligence. Carelessness, that is careless auditing. So that is the civil one. And it means that an individual who uses the audited financial statement can, if he has used that one and then there is a problem, he can sue you in court for civil liability. A tort can be defined as a civil wrong other than that arising under contract law, giving rise to a claim for damages. Negligence is just one of many branches of torts. Yes, negligence of duty. Making a successful claim for auditor negligence. How can you make a successful claim for auditor negligence? If a person is to make a successful claim against the auditor in the tort of negligence, 3 conditions must be satisfied. For individuals who want to take the auditor to court under negligence, he needs to what? Fulfill 3 conditions. If those conditions are not fulfilled, please, the case will be thrown over the board. Condition 1 is the auditor must owe a duty of care to the person who has suffered a loss due to the auditor's negligence. So the first one is what? The first one is duty of care. That's it. This one. Duty of care. Duty of care. That's the first one. The second one is the duty of care must have been broken. That duty of care might have been broken. The third one is a loss or damage must result from what? Breach of the duty of care. If there is no loss, if you send a case to court, you lose. If there is no duty of care, you send the auditor to court, you lose. But the first condition is what? He should owe a duty of care to the fellow who is sending you to work. All right, let's go on. Out of court settlements. Yes, sometimes auditors can call for out of court settlements. Under this one, they say you have been beaten. Is that also? You saw that you are guilty already, so you don't want the case to go to court. This involves the parties who are in dispute reaching a negotiated settlement rather than taking their case to what? Court. So, out of court settlements. The two of you agree that after that, then you inform the court. The advantages of out of court settlement are that it avoids the cost and time involved in court case. Yes, it's true. The timing and the cost is good. It may avoid adverse publicity for the auditor. Yes. It will avoid that one because the auditor is not highlighting any paper. Therefore, publicity is a bit. Then the final settlement may be lower. The two of you, when you come together, at least because both sides have legal costs. Nobody hires what? A lawyer. Therefore, it may be lower. Now, there's no coin with what? Advantages without disadvantages. The disadvantage of out-of-court settlements are that the final responsibility may be left undecided. So, the legal position remains unclear because they haven't come to conclusion. Therefore, that is the undecided side of the case. We just agree that, okay, let me pay you this. What about the case itself? Are you at fault or I am at fault? So that one is what? It remains unclear. It may encourage others to act against auditors. Yes, since Ahmad did it, the case in the good court, it will happen. Insurance premiums may arise. Yes, insurance premiums may arise. Because the auditor may insure his citizens and the premiums may rise. They may rise. All right, let's go. Use of disclaimers in audit reports. As part of your mitigating factors or how to do it, a disclaimer is not a requirement of an audit report. But some audit reports include one. A disclaimer is what? What is a disclaimer? A disclaimer states that the auditor's report is intended for use of what? The company and the company's shareholders as a body. That is the one thing. Because if you are not a shareholder, you cannot. Then no responsibility is accepted by the auditor to anyone except the company or the shareholders as a body for the content of the report. So you are disclaiming that if the one who is taking you to court is not a shareholder, or even if it's a shareholder, the shareholders as a body should take you to court. Individually, they cannot do that. So So that is what we call what? Oh, shit. The purpose of a disclaimer is to reduce the risk of what? Legal claims by third parties. It's true. That is the disclaimer. The reason why you are doing disclaimer. So that any third party who intend to use your information, your audited report, and later on send to court, the fellow will not get headway. That's why. Against the auditor for what? Negligence. Managing the auditor's liability. Yes, auditors have liabilities, as we said. How do you manage it? There are ways and means by which you can manage it. One of the avoiding liability, you can avoid it. You can avoid something. Auditors should therefore follow appropriate auditing standards. If you avoid the liability, it means you are doing the right thing by following appropriate auditing standards. So if you don't want to pay tax, don't buy ice water or what we call chassis water, because there is tax on it. Don't buy drink. You buy any drink, there are tax on them. So if you want to avoid it, then it's better you don't buy. So follow appropriate auditing standards. Once you follow appropriate auditing standards, then you are okay. You must use effective quality control procedures. If you do this, you are trying to avoid liability. Train staff to an appropriate level of knowledge. Train your staff to what? An appropriate level of what? Knowledge and skill. And what? Skill. And then ensure that the firm is up to date with what? Modern auditing methods. There are so many methods in auditing. So make sure that the firm you are using is up to what? The standard. That means the modern auditing standards or methods. Now, assuming the claim comes, the first one is avoiding. Now, assuming you didn't avoid it, it comes. Meeting that claim, the legal claim, you are meeting it. So, professional indemnity. So, the one of the means by which you can meet that claim is that you go and insure with insurance company, what you call professional indemnity insurance. Professional indemnity insurance. If successful legal claims are made, if out of court settlements are reached, where the audit firm agrees to what? Make a payment to settle the dispute, the auditor will have to pay damages. Whatever it is, you pay damage. Whether you go to court, you pay. Even if you settle on it, now you out of court settlement, still you pay. If the damages are so large that they are more than the firm can afford, the law in some countries may also allow claims to be made against the personal assets of what? Partners of the audit firm. So what I say is that if you go into the court or whatever it is, and the cost involved is too much for your take, they'll take all your properties and even go to your bedroom and take your bed. And if that is not enough, you have to remove your sandals or your shoe, everything, and they'll take everything. Because of lack of financial resources, okay? As a result, professional bodies often require members in practice to carry professional indemnity insurance. P is an insurance policy that provides cover against all civil liabilities. Against what? All civil liabilities that are incurred as a result of the conduct of the business or the firm's business. P is an insurance policy which you take from. So let's go to the disadvantages. Compulsory P. It may increase the frequency and size of claims made against firms, which are seen to have large amount of funds at their disposal to meet them. Yes, that's the disadvantage. Once they know that any claim that comes, you are able to pay it because the insurance company will come and bail you out. Frequent court judgments will be against you. It may encourage more careless auditing. Yes, you yourself, because you know there is some backup. So you do careless job. When there is a problem, the insurance company will take it out. It imposes high costs on audit firms. Yes, once your case goes, the insurance company come and pay. Once the cases are coming, they'll increase your premium. And when they increase the premium, it is the high cost of what? To the audit firm. Limiting, now the first one is you are trying to what? Let me see. Okay. Meeting the claim. Now, we are going to limiting the claim, the liability now. You want to limit it. You don't want it to go too high. Because of the high cost of legal claims and professional indemnity insurance, a number of suggestions have been made for finding out ways of limiting claims against auditors. So because of nowadays, auditors, and they go to court, the money they have been charging or giving to the auditors is too much. Because of that, you will also find this by limiting it so that even if it will go up, it will not be too much. One suggestion is that there should be a statutory limit on claims, either a maximum percentage of the audit fee or a maximum fee amount, fixed amount. So that is one of the suggestions. That they should make it such a way that a percentage of the audit fee that I charge should be the claim, or just a fee which they can think is applicable should be fixed. The next one is another suggestion is that auditors should be permitted to agree a cap limit on their liability with their clients, so that a company cannot make a claim against its auditors for more than the agreed amount. So there's another suggestion that the liability there should be a cap on the liability, meaning that there should be maximum which the courts can charge. The use of limited liability partnership is also another one. If you form a limited liability company partnership, you only incur up to the what? The money you have invested in a partnership. Whereby an audit firm that is structured as a limited liability partnership cannot lose more than its total fixed capital. That's all. So you can form a limited liability partnership. That is another way of limiting it. The next one is the use of the equivalent of P for directors of client companies. And some people are also suggesting that the client companies should also be insured, because according to them, it's they who prepare the financial statement for the auditor to audit. Therefore, if there is anything, they should be charged only the auditors, but those who prepare the financial statement should also be equally charged. Including this, that one also includes disclaimers of liability to parties other than the company and its shareholders in the auditor's report. So you can disclaim as well. Thank you.